Hey, what's going on everyone? My name's Griffin, and if you've clicked on today's video, then it's safe to assume that you're interested in investing and having your money being active in the stock market. And I'm here to tell you that this is the first step to success to achieving your financial goals, so good job. Now, I do realize that if you're new to investing, knowing where to start can be quite confusing, especially with all the different terms that you've definitely heard over the years. But rest assured that by the end of today's video, you're gonna have all the necessary steps and tools to start investing and be on the right track for your financial goals. And as per the title of today's video, I chose to use $1,000 as a pretty round number, but the concepts are going to stay the same whether you have 100, 200, 500, or even a couple $1,000s to start investing with. And the reason why this video is tailored more specifically towards millennial investors is because generally speaking, the portfolio balance of a younger investor is going to be tailored differently than an older investor based on the different goals that you're looking to achieve with your financial portfolio. The specific investment vehicles that we're going to be covering for millennials are more heavily weighted towards stocks, which usually come with a higher level of volatility and risk. The reason for this is because as a millennial, you'll more than likely have a longer investment horizon in front of you rather than an investor who's say 40, 50, or 60 years old. This gives you significantly more time in the market and will allow you to ride through both bull and bear markets to most likely come out in the positive over the long run. This will significantly allow you to benefit from dollar cost averaging over the course of your investment career, as well as compound interest, which is the most powerful tool within any investor's arsenal to build their wealth over the long term. So let's now take a preliminary look at the different steps that you're going to have to accomplish in order to start investing your first $1,000. The first step is going to be choosing which broker is right for you, because to buy and sell stocks and index funds, you're going to need a trading account with an online broker. The second step is going to be choosing which account type is the best suited for your goals as an investor, so we'll be covering the different account types based on your situation. Once you've chosen your broker and opened the correct account, you're going to need to have a clear picture of what the asset allocation inside your portfolio should look like. So how much of your capital is going to be allocated to equity, so stocks, and what percentage is going to be allocated to fixed income such as bonds. The next step in the process is going to be, well, what actual assets do I buy? Now, obviously, this will be different for each person, but I'll be giving you specific examples of assets that you could consider including in your own portfolio. And then the fifth and last step is going to be repeating steps 3 and 4 for as long as possible on a consistent basis. So with that now out of the way, let's get right into it. As a millennial, you're probably quite used to doing everything online, including your banking, and the same holds true for your online stockbroker. There's a variety of different online stockbrokers that you can choose from as a Canadian, which each come with different pros and cons, but for the likes of today's video, that would take probably about 5 to 10 minutes to go through every single one of them. So I highly recommend that you check out the video that I'm linking right here, where I was talking about the 5 different online stockbrokers that I would choose from if I was you. Now, however, if you don't have time to check out that video, I would personally recommend going with Questrade because they offer free and unlimited ETF trades, which is going to be highly beneficial over the long run of your investing career. And on top of that, if you sign up using the link down below, you'll receive $50 in free commissions for any stocks that you want to trade on their platform. So once you've either watched my top 5 online Canadian stockbroker video or you've opened your account with Questrade, then we're ready to go on to the next step on your investing career. Step number 2 is going to be choosing which account type is going to be correct for your personal situation with your investments, because an investment account is different from your typical checking or savings account. You actually can't purchase any types of investments such as ETFs, stocks, bonds, or anything like that in your typical checking or savings account. You actually have to have a specific investment account such as an RRSP or a TFSA in order to buy and sell financial assets. Now, while step number 2 can seem quite simple and straightforward, it's absolutely critical that you use the correct account type so that you can save on both income tax and capital gains tax, which can have a significant impact on the long run. Otherwise, you could be leaving a lot of money on the table rather than in your own pocket. Now, if you did watch my other video relating to online stockbrokers, then you would have been made aware of the 2 registered accounts that I would recommend, which are the TFSA, so the tax-free savings account, and then the RRSP, which is the registered retirement savings plan. These are the 2 main account types that we're going to be discussing in today's video, because as a millennial, you're going to want to utilize either or of these 2 accounts in order to benefit from significant tax sheltering. Both the TFSA and the RRSP are registered accounts that will come with tax sheltering benefits, but the main difference between the 2, although there are a ton of different differences, the main one is when you're going to be paying tax on your investment. With the TFSA, you're contributing post-tax income, meaning that you're paying income tax in the year that you're contributing rather than paying income tax when you withdraw the funds, meaning that your investments will grow completely tax-free. So for example, if you put $500 into a TFSA account this year, you've already paid your income tax on that $500. But if you buy certain investment vehicles with that $500 and in 10 years it grows to $1,000, well, when you withdraw that $1,000 from the account, you're not going to be paying any income tax on the entire $1,000. Now on the flip side, the RRSP is pretty much the opposite, meaning that you pay income tax when you withdraw the funds rather than the year that you put the funds in. In fact, when you make an RRSP contribution, it's actually a tax write-off for that specific year on your personal income tax. So once again, if you put $500 into an RRSP this year, you're going to be paying your income tax on that entire income minus the $500 for that year. But if that $500 grows to $1,000 over 10 years, let's say, when you take that $1,000 out, you're going to be paying income tax on that additional $1,000 of income for that specific year. Now, if you want my personal opinion on which account type you should open as a beginner investor, I would say open both. However, I would max out my TFSA contribution limit before contributing to the RRSP. Now, although everyone's financial situation is going to be different, and I recommend that you do your own research and due diligence before taking any advice from anyone, my general logic here about the two accounts is that as a younger investor or a millennial, you'll more than likely be in a lower tax bracket now than later on in life when you want to withdraw those funds. This means that either way, I'm paying less income tax now, and later on in life when I want to withdraw those funds out of the TFSA, I don't have to add that income to my higher income anyways later on in life. If you want more details about the ins and outs of a TFSA account, including what contribution room is and all those details, I made a video right here that you can check out where you'll be extremely knowledgeable on the subject after watching it. But just to summarize point number 2, as a millennial, I would recommend opening a TFSA account. Alright, so now that we're past all the paperwork and the boring stuff, you're pretty much good to go and won't have to worry about this again because your accounts are now open. So we're now ready to invest that first $1,000 that's sitting in cash in your account. The next step of the process here is going to be determining how you want to divide your money into different categories of investments within your account. So I'm talking here about what percentage of your portfolio you want to have tied up in stocks rather than tied up in bonds. If you're new to investing and don't fully understand the difference between stocks and bonds, a stock is essentially a type of financial security that signifies that you own a portion of a publicly traded company. This entitles the stockholder to that proportion of the corporation's assets and earnings. Now, when it comes to bonds, however, a bond is a fixed income financial instrument that represents a loan made by an investor to a borrower, and typically the loan is going to be issued by either a corporation or a governmental entity. Understanding the difference between stocks and bonds is extremely important as an investor because each one will yield extremely different results within your portfolio. And the asset allocation between stocks and bonds within your investment account is going to be highly dependent on your goals as an investor. Now, as a millennial myself, I would recommend having a portfolio that's more heavily weighted towards stocks rather than bonds. This is because historically speaking, stocks will pretty much always outperform bonds due to the nature of what the investment actually is. Now that said, being invested more heavily in stocks will come with more volatility because you're essentially investing within companies that will inevitably go through ups and downs within the long run. Now on the flip side, if you're invested with bonds, you're essentially loaning out your money to a corporation or a government, which is going to most likely give you a pretty low interest rate. So while investing in bonds is a more steady and conservative investment, you can't really expect any explosive growth such as if you were invested in stocks primarily. So how all this information ties into asset allocation is that most investors will have different investment vehicles within their portfolio in order to diversify their portfolio. This can vary from stocks, bonds, mutual funds, real estate, land, or pretty much anything that has the potential to show a positive return. In this video, however, we're strictly going to be looking at the asset allocation within your investment account for stocks rather than bonds. And once again, as per the title of today's video, being a millennial, you'll have more time on your side and more time within the market. So for this reason, I would recommend having 80 to 85% of your portfolio being tied up in stocks and about 20 to 15% tied up in bonds. This will expose you to both and will somewhat diversify your portfolio while having a higher potential of being exposed to explosive growth because your portfolio is more heavily weighted towards stocks. So pretty much as a millennial and having more time on your side to benefit from dollar cost averaging and compound interest, I would recommend having more of your portfolio in stocks because once again, historically speaking, stocks will always outperform bonds. However, it's still important to have a certain amount of bonds within your portfolio in order to smooth out your returns over the long run, because generally speaking, when the equity markets are kind of in a lull, the fixed income markets will tend to be doing better. So if, for example, though, you were 100% tied up in stocks and the equity markets were doing really poorly, then your portfolio is most likely going to take a significant hit because you have nothing else to balance out the returns. So this now brings us to the most interesting part of the video, which is step 4 of your investing career, which is what actual stocks and bonds should I be purchasing in my investment account? Now, it's extremely difficult for me to give you specific examples of which stocks and bonds would be most beneficial for you because this is going to be highly dependent on what your goals are as an investor. Now, technically speaking, you could go out tomorrow and buy different shares in like Apple, McDonald's, IBM, ExxonMobil, or whatever other blue chip stock that you want. But by investing directly into specific companies, it's extremely important that you do your due diligence and your research to know exactly what you're buying into. The reason for this is that any volatility in those single stocks that you picked are going to directly impact the returns in your investment portfolio. And let's now remember that one fundamental principle that we touched on earlier in this video, which is diversification. Diversification is the act of owning multiple investment vehicles in different industries in order to smooth out returns and mitigate losses when a certain industry is underperforming. However, I do realize that diversification can be pretty hard to achieve when you're starting with limited capital, such as say $1,000. And that is where index funds come into play. If you haven't watched my index fund for beginner video, then I highly recommend that you check it out so that you can see how index funds can work to your advantage within your portfolio. Now, personally, my portfolio is comprised exclusively of ETFs spanning the US stock market, global and emerging markets, as well as a Canadian aggregate bond index, all offered by Vanguard and Horizon, which are two of the largest index fund management companies in Canada. Now, to get a bit more granular here without going too deep into detail, I currently own and hold VFV, which is Vanguard's S&P 500 ETF, which is currently trading at $70.20 per share. I also hold HXQ, which is Horizon's NASDQ 100 ETF, that is currently trading at $58.76 per share. I also own VAB, which is Vanguard's Canadian aggregate bond ETF, VUN, so Vanguard's US total stock market ETF, the XC, which is Vanguard's global all cap ETF, and then also I hold a bit of XUS, which is iShares Core S&P 500 Index ETF. Now, once again, I explained my reasoning behind holding exclusively ETFs within my portfolio in the other video, so make sure to check it out. But also remember that I mentioned earlier in this video that Questrade offers free and unlimited ETF trades. Essentially what this means is that you can build the exact same ETF portfolio that I built, and all of this can be achieved with zero commission fees whatsoever. If you do decide, however, that you want to purchase some individual company stock though, you can do so at $4.95 per trade, meaning that if you use the link down below, you'll get $50 in free trades, equating to roughly 10 free stock trades. It's pretty much a win-win situation for your investing debut, and what's best is that it only takes about 10 minutes to set up your TFSA account with them. Alright, so now that we've gone through steps 1, 2, 3, and 4, the fifth step in this equation is going to be rinsing and repeating steps 3 and 4, which is purchasing the same ETFs over and over again with a long-term horizon ahead of you. If you're interested in knowing more specifically what ETFs I purchase, I'm going to be writing them down below in the description so that you can check it out. And they're also outlined more in depth in the index fund investing for beginner video that I also linked down below for you guys. And if you get anything out of this video, I want you to retain the fact that as a millennial, if you start investing earlier, you have time on your side to benefit from compound interest to its fullest. So make sure that you start investing as soon as possible. And I really hope that today's video gave you the correct steps to put you on the right track to starting your investment career. Continue investing in your own knowledge on the subject and make sure to not have a short-term mentality when it comes to investing, because once again, as a younger individual, having a long-term outlook on investing is going to be beneficial to you. So that's really it for today's video. I hope that you guys enjoyed it. If you did, make sure to give it a like and subscribe to the channel. We talk here about personal finance and business, so if that's of interest to you, make sure to subscribe to the channel. And on that note, I'll see you soon.